So the consensus data feeds are just completely conflicted this morning. Investing.com is reporting that Grupo Supervielle missed expectations with an EPS of roughly 13 cents against a 15-cent forecast. So that's a 13.45% miss.
Right.
But then, you look at other market feeds like Zacks or MarketBeat, and they're reporting this massive beat of 29 cents. But I mean, regardless of which EPS feed you're actually looking at, revenue came in exactly in line with forecasts at $219.58 million.
Exactly in line. Yeah.
Yeah. And as for guidance, management actually cut their real loan growth targets down to a range of 10 to 15%, which is down from their previous expectation of above 20%. They also raised their full-year net interest margin, or NUM, guidance to 17 to 19% and lifted CET1 capital guidance to 12 to 14%.
Wow.
And just wrapping up the headline numbers, the stock reaction shares fell 1.18% in the regular session to $8.38 and slipped another, 0.24% after hours.
For anyone reviewing a bank's balance sheet, that CET1 figure you just mentioned, the Common Equity Tier 1 capital, that is really the ultimate metric for financial strength, right?
Right, the shock absorber.
Exactly. It measures the bank's core equity capital against its risk-weighted assets.
Oh.
Pushing that guidance up to the 12 to 14% range, that signals management is building a massive shock absorber. And honestly, that ties directly into the mission for this deep dive.
Yeah, we have a lot to unpack.
We really do. We need to figure out how a bank with such, confusing consensus picture managed to swing from an 18 billion peso loss in the first quarter to a 13 billion peso profit in the second quarter.
Which is huge.
It is. And more importantly, we need to distill what you, as a retail investor, actually need to know about the underlying structural mechanics driving that profitability.
Okay, let's unpack this, because swinging from a massive loss to a solid profit, while your top-line revenue just sits perfectly flat, exactly in line with forecasts, it's quite the magic trick.
It really is.
Usually you need a revenue surge to dig out of a hole that deep. So to understand how Supervielle pulled that off, we have to look directly at the balance sheet, not the income statement.
Right.
Specifically, it looks like management pulled two massive levers, a drastic reduction in headcount and a perfectly timed drop in their own funding costs.
Yeah. The most permanent change they executed was completing what management described as a major right-sizing program.
Yeah.
Which, in plain operational terms, means they eliminated 17% of their total workforce compared to the end of last year.
17%. That is...
Yeah, we're looking at 553 employees leaving the company, and 262 of those cuts happened in the second quarter alone.
A 17% reduction in headcount isn't just trimming the fat. That fundamentally changes the physical footprint of the entire business. You don't cut nearly a fifth of your staff unless you're, totally abandoning an old way of doing business.
Absolutely, and that is the core strategic pivot here. They are actively aligning their workforce to match a digital distribution model. Retail banking globally, but especially in emerging markets, is aggressively moving toward virtual hubs, integrated apps, automated client service.
Right, less brick and mortar.
Exactly. Supervielle recognized that the physical, human-heavy infrastructure of traditional branch banking was becoming this massive, unnecessary liability. And the financial result of tearing down that physical infrastructure is that they locked in approximately 42 billion pesos in annualized salary savings.
Which is a massive number. But those savings didn't exactly come for free this quarter, right? Because when you let go of 553 people, you have to pay out severance.
You do.
And in a heavily regulated labor market like Argentina, those exit costs are steep.
Oh, they are incredibly steep.
Right.
It cost the bank 23 billion pesos in after-tax severance charges just to execute the layoffs in the first half of the year. Yeah, and this is a crucial concept for you, the investor, to grasp when you're analyzing a bank going through a turnaround. The headline net income number includes that massive 23 billion peso penalty.
Right.
But if you exclude those one-time severance charges, like if you looked at the business without that friction, their adjusted net income was actually 36 billion pesos.
Which brings us to their structural return on equity, their ROE. The reports show a structural ROE of 14.4%.
And, well, the word structural is doing a lot of heavy lifting there.
Oh, for sure.
Structural ROE is a theoretical metric. It essentially asks the question, what is the earning power of this bank's underlying engine once we remove the one-time weight of firing 17% of the staff.
Right, assuming the dust has settled.
Exactly. Assuming the full ongoing benefit of those 42 billion pesos in salary savings, generating a 14.4% return on the equity shareholders have invested. It's a very robust baseline, especially when you consider the volatility of the local currency.
It's basically like cutting the anchor line while catching a massive tailwind. I mean, they slashed their fixed operating costs right at the exact moment that the macroeconomic winds shifted in their favor.
Yes.
Which brings us to that second lever, their net interest margin, NM. The data shows their NM expanded by 250 basis points sequentially. So essentially a full 2.5%, hitting 20.3% for the quarter.
Which is wild. You really have to break down the actual mechanics of why that margin expansion happened, because it goes to the heart of how banking operates in a volatile interest rate environment.
Right.
A bank is essentially just a machine that buys and sells liquidity. The raw material they buy is customer deposits, and they pay for that material via interest rates.
Sure.
The product they sell is loans, and they generate revenue by charging interest on those loans. So the net interest margin is just the markup between what they pay out and what they collect.
So in the second quarter, market interest rates in Argentina began to settle at lower levels, right? The central bank was shifting its policy, driving the overall cost of capital down.
Yeah, and when those benchmark rates drop, the liability side of a bank's balance sheet, the deposits reprices almost immediately.
Oh, because they're short term.
Exactly.
Huh?
The vast majority of deposits in Argentina are sight deposits or very short-term vehicles.
Yeah.
So Supervielle was instantly able to slash the interest yield they were paying out to their depositors. Their funding costs plummeted overnight.
But the asset side of the balance sheet, the loans they had already written to customers didn't reprice nearly as fast.
That's the mechanical mismatch that generates the profit.
Yeah.
The loans sitting on their books are often fixed contracts stretching out 12, 24, maybe 36 months.
So the customers are stuck paying the higher rates.
Exactly. Those borrowers are locked into the higher interest rates from previous quarters. So for this brief, incredibly lucrative window, Supervielle was paying out drastically less on their new deposits while still collecting the old sky-high interest rates on their existing loans. That delayed repricing lag widened their spread dramatically, pushing that NIM up to 20.3%. And it also massively improved their efficiency ratio, bringing it to 63%, or roughly 52% if you adjust for the one-time severance costs.
Okay, here's where I really have to push back, though. As an investor looking at a 20.3% margin, I have to ask, is this just a temporary sugar high?
Yeah.
Because, management's own full-year guidance expects NIM to normalize back down to a range of 17 to 19%. So they clearly know this 20% margin is mathematically unsustainable.
Oh, absolutely. And management is being very transparent about that reality.
Yeah.
The 20.3% was absolutely the peak of the wave.
Right.
As those older, high-yielding loans eventually mature over the next few quarters, the new loans replacing them will have to be written at today's lower competitive interest rates.
So the spread shrinks.
The asset side of the equation will inevitably reprice downwards, yeah? And the spread will compress. That is why they're guiding you to expect normalization in the second half of the year.
So what does this all mean for the next quarter? Because if margins are guaranteed to compress in the second half of the year, basic math says the bank needs higher loan volume to compensate.
Sure.
If you're making less profit on every individual loan, you need to write more loans just to tread water. But when you look at the balance sheet data, their total loan book actually shrank by 1% sequentially. Why on earth is a bank pulling back on lending when they know their profit margins on each loan are about to shrink?
Because blindly chasing loan volume simply to make up for shrinking margins is the fastest way to destroy a bank's balance sheet.
That's a fair point.
Management is making a highly deliberate defensive choice here. They are prioritizing risk-adjusted returns over pure volume growth. And to understand why, you really cannot analyze an Argentine bank without pricing in the macroeconomic reality of the country right now.
Right. We're talking about an environment coming off extreme hyperinflationary pressures where consumer purchasing power has been severely eroded and wage growth hasn't entirely caught up to the cost of living.
Exactly. That macroeconomic pressure translates directly into elevated system-wide delinquencies.
Mm-hmm.
The average consumer is financially stretched.
Yeah.
Throwing unsecured credit-like personal loans or credit card extensions at a weak consumer market is just a recipe for catastrophic default rates. So Supervielle pulled back aggressively. We saw retail loans actually decline by 2% in the quarter.
A bank refusing to lend to retail customers is literally like a retail store refusing to sell its inventory. I mean, it protects them from bad debt, sure, but how do you sustain a business that way? Are they just sitting on their hands?
No, they aren't sitting on their hands at all. They're shifting their focus to where the collateral is stronger.
Okay.
While retail lending contracted, commercial lending was much more resilient. That segment was specifically supported by a 6% growth in U.S. dollar-denominated loans. And at the same time, while they were shrinking the asset side of the book, they were aggressively capturing more liabilities. Total deposits rose 4.7% sequentially.
Which brings their loan to deposit ratio down to 72.6%. That is a fortress of liquidity.
It is.
They are sitting on a massive pile of deposit cash. They're just actively choosing not to deploy it into risky retail loans.
And that discipline is the exact reason their asset quality metrics are arguably the brightest spot in this entire earnings report. When a bank stops chasing risky volume, the health of the existing portfolio usually improves. Their non-performing loan ratio, the NPL ratio, improved to 5.5%.
And to put that 5.5% into context for you, the current banking industry average in Argentina sits at 7.6%. So Supervielle is operating a full 210 basis points over 2% below their peers when it comes to the proportion of bad loans on the books.
Exactly. Furthermore, their cost of risk eased to 5.6%, which is down from 6.0% in the previous quarter.
Which is great.
Yeah, the cost of risk measures how much capital the bank has to set aside to cover potential future defaults. Because they are lending more conservatively, they don't have to hoard as much protective capital.
Right.
And even more importantly, the second quarter marked their second consecutive quarter of declining NPL formation.
So it's a trend.
Yeah, they aren't just managing the bad loans that are already delinquent. The actual rate at which new loans are turning sour is actively slowing down. Going back to your store inventory analogy, yes, they are choosing to sell less inventory, but the inventory they are putting on the shelves has a statistically higher likelihood of actually being paid for.
Okay. That logic holds up perfectly. But it raises a very difficult structural question. They just cut their full-year real loan growth target to a range of 10 to 15%. If they are deliberately starving the broad retail market of credit because the average consumer is too weak, how do they plan to achieve even that revised lower growth target? Where is the demand going to come from?
Well, that requires us to look at exactly where they are choosing to deploy their capital. Since they are refusing to lend to just anyone, their capital deployment has to be hyper-targeted. They are searching for insulated pockets of the economy.
It's like spearfishing instead of casting a wide net. You know, instead of dragging a net across the broad consumer market and hoping the catch is good, they're aiming at very specific, high-value, collateralized targets.
That is the exact strategy playing out on the corporate side of the business. Their spearfishing is focused heavily on the energy, oil and gas, and export sectors. They're actively shifting capital toward Vaca Muerta, which is, one of the largest shale oil and gas deposits globally, located in western Argentina.
Right.
But the real structural plays are focused on the RIGI projects.
The large investment incentive regime.
Yes. The RIGI is a government framework designed to attract massive long-term foreign and domestic capital by offering tax and customs stability.
Right.
Currently, there are 21 approved RIGI projects, representing a staggering $47 billion in planned capital investments. But Supervielle's strategy here is brilliant because they aren't necessarily trying to fund the multinational conglomerate digging the hole or building the refinery.
Because that's too competitive.
Exactly. That is highly competitive, low-margin lending. Instead, they're explicitly targeting the value chains downstream.
Wait, explain how that downstream financing actually works in practice. Like, why is that a better bet for the bank?
Okay, imagine a local logistics company that just won a 5-year contract to haul heavy machinery for one of these massive $47 billion RIGI projects.
Okay.
That logistics company needs a fleet of new trucks. Supervielle steps in to finance the trucks. The loan is de-risked because the logistics company has a guaranteed multi-year, often dollar-pegged revenue stream from the mega project above them.
Oh, that makes sense.
Right. By financing the suppliers, the contractors, and the vendors feeding the RIGI machine, the bank captures high-yield commercial loans that are backstopped by the predictable cash flow of the macro projects.
That covers the corporate side. But what about the retail side? If they are shrinking broad, unsecured consumer credit, who are the individuals they're actually willing to lend to?
They're building creative, closed-loop partnerships to find prime borrowers. Like in the fourth quarter, they're launching a major partnership with Flash Argentina, which operates directly within the Mercado Libre ecosystem.
Mercado Libre being the e-commerce giant of Latin America.
Right. But this specific partnership is highly specialized. It is designed to finance peer-to-peer vehicle transactions on the platform. Think about the mechanics of peer-to-peer auto sales. You have two individuals trying to transact a high-value asset, and trust and financing are always the bottlenecks.
Yeah, for sure.
By integrating into the Flash ecosystem, Supervielle provides the point-of-sale liquidity. And more importantly, an auto loan is a secured asset. The vehicle itself is the collateral.
So they have something to fall back on.
Exactly. If the consumer defaults, the bank can repossess a hard asset that, historically, holds its value quite well in an inflationary environment. It is a fundamentally safer way to deploy retail capital than handing out unsecured credit cards.
And they are applying a similar de-risking logic to their other retail partnerships too, like their deal with Aerolíneas Argentinas, the national airline.
Yeah.
They are using that partnership to target premium identité clients as well as payroll customers. Again, it's pure spear phishing. You target individuals taking frequent flights or people whose corporate paychecks are directly deposited into your banking ecosystem.
Right.
You have direct visibility into their recurring income and their spending habits. That data advantage massively de-risks the lending decision.
So they are finding these very specific collateralized pockets of loan demand. But if your overall loan book is still shrinking in the near term, you eventually need to find revenue streams that do not rely on credit risk at all.
Right.
Which brings us to their fee-generating businesses, specifically their digital investing arm, Inverter Online or IOL.
The data on IOL is fascinating. They've seen assets under custody reach the $3 billion mark.
The total asset growth is impressive, yes, but the behavioral shift management noted is what truly matters for the bank's structural health. They are seeing their user base shift away from high-frequency, short-term speculative trading and move toward longer-term structural investing. Yeah, from a banking perspective, a short-term trading base is volatile revenue. A long-term investing base represents sticky assets under custody.
Much more reliable.
Exactly. It shows maturing of their digital retail footprint, building a highly stable capital markets environment that generates consistent fee income without requiring the bank to put its own balance sheet at risk.
Okay, so here's where it gets really interesting. When you pull all these complex threads together, the severance costs, the NIM mismatch, the spear phishing strategy, the digital fee generation, what is the final verdict for you, the retail investor, looking at this quarter's performance?
The verdict is that management has successfully executed a deeply painful but operationally necessary turnaround.
Yeah.
They took their medicine early. They absorbed the 23 billion peso severance hit to create a structurally leaner cost base. And through sheer lending discipline in a brutal macro environment, they have pushed peak credit losses into the rearview mirror. Operationally, they are a drastically healthier, more efficient machine today than they were 6 months ago.
But the road ahead requires a completely different set of skills. Cutting costs to survive is one thing. Generating organic growth is another.
That is the pivotal challenge. They are now facing a decidedly softer margin environment as that delayed repricing lag normalizes and the sugar high fades.
Right.
The real test for management in the second half of the year is whether they can successfully execute this spear phishing strategy. They have to prove they can reignite meaningful loan demand in the corporate value chains and the secured auto market to hit that 10 to 15% growth target.
They have to prove they can grow the loan book again without breaking the shiny new risk models that brought their non-performing loans down in the first place.
That is the exact tightrope they are walking. Growth without sacrificing discipline.
Well, if you're finding this kind of mechanical breakdown helpful, make sure to follow the show. We do these deep dives into earnings reports daily, cutting through the noise so you understand exactly what the underlying fundamentals are signaling to the markets.
And we always try to leave you with a larger provocative question, something to help you connect this single corporate earnings report to the broader macroeconomic picture.
And for Grupo Supervielle, the lingering multi-year question is all about systemic capacity. We know they just paid a massive premium to cut 17% of their workforce to shift toward a lean digital-first model. They closed the physical doors, reduced the human footprint, and pushed their customer base toward apps and automated platforms.
Which is undeniably the correct play for preserving capital and cutting costs in a stagnant, highly inflationary economy.
But what happens if Argentina's macroeconomic stabilization actually holds over the next 3 years? Like, what happens if inflation truly bottoms out, consumer purchasing power sharply recovers, and mainstream unsecured credit demand suddenly explodes across the broader middle class?
It's a great question.
Will this leaner, digital-only ecosystem relying on platforms like IOL and the Mercado Libre partnership be agile and robust enough to capture that massive, historic wave of retail demand? Or will management find themselves completely overwhelmed by the volume, scrambling to rebuild the very physical infrastructure and human capital they just paid 23 billion pesos to permanently remove? It really is the ultimate double-edged sword of right-sizing.